For everyone on the line, this is part of our Neoclassic Talk series. So basically, we from time to time have a topic that I think has gathered enough momentum where it's worth addressing to our LPs, our partners, and to a broader audience. And with that, we bring on, content experts, people from the field. In this case, we have Raj Parekh, who I've known for actually a fairly long time now, a couple of years, 3, 4 years, to discuss the area of stablecoins, payments, embedded finance. It's an area that I think a lot of people are now familiar with. I think the more well-known names of the likes of Circle and Tether are kind of top of mind for everybody. But this is intended to kind of dig into what it all is, where we're seeing actual adoption. I think we have an exceptionally interesting interview today. I'll call it an interview. Raj came from, much like myself and Steve, from the TradFi or trad tech world, and kind of went into being an operator and building his own company in Portal, being acquired by Monad, and now is running the stablecoin and payments side of Monad Foundation, which is one of the larger new L1s that's launched recently. So all that being said, before we kick off, I do have to read our disclaimer just to obviously cover all bases. So before we get started, a quick disclaimer. The discussion today is for informational purposes only and reflects our views as of today. Nothing we say should be considered investment advice, and offer to buy or sell securities, or a recommendation to pursue any specific strategy. Any forward-looking statements are based on assumptions and subject to change. Participants should conduct their own independent analysis and consult their advisors before making any investment decisions. This session may include references to portfolio companies or opportunities, and those references are for illustration only. Nothing here should be relied upon as a commitment from us or affiliates. Finally, please do not distribute or quote this conversation without our prior consent. Okay, Raj, welcome to Neoclassic Talks. You are our highlight guest for one of the, I would say, largest areas of adoption of crypto to date, stablecoins. And if you don't mind, I'm going to ask you to kind of, tout yourself to your own horn and give us a bit of background on your career and where you stand today.
Yeah, first off, thanks for having me. This is gonna be a lot of fun. Yeah, first off, started my career at Visa, was there for about 7 years. So I actually come from the fintech payments world to what Michael was mentioning. First half of my time was building out a security platform for banks, helping them think about breaches, exploits, and hacks. Intersection of security and payments went down the crypto rabbit hole. From there, I was in the front lines of the Facebook Libra Association days. Visa was a member as a part of that. And as a byproduct of that, I was summoned to lead crypto products there. I was one of the few folks that were crazy enough to understand this world. From there, I launched stablecoin settlement, which was a way for issuing banks and acquiring banks to settle with public blockchains and stablecoins. We felt like, this was like 5, 6 years ago. We felt like Visa was well positioned to be in the stablecoin space. This was new payment technology that we should harness. I left to build my company Portal, which is a stablecoin developer platform. We work with old remittance companies that are like 15 years old now that are now leaning into stablecoins. We work with freelancer platforms, payroll, and what I joke, boring use cases around
Yeah. What
payments.
were some of the names in that world?
Yeah, I mean, you can World Remit is a big one.
Yeah.
15 years old, they have 8 million monthly active users, 120 countries. We just announced a few weeks ago that they're live with their stablecoin product where they can move that globally. We have there's like PayPal, there's Bitso, there's I think the list of traditional companies leaning into stablecoins is becoming more apparent. Where our company Portal was acquired by Monad Foundation. Monad is an L1 blockchain, but not like the previous legacy blockchains. It's a high performance, sub-second finality, low transaction fees. Is actually what's missing in the stablecoin space. When I built stablecoin settlement at Visa, we're using Ethereum mainnet, which is quite expensive. It was $20 to move $100, which our treasury team back then was like, this makes no sense. Now with new systems like Monad, you can actually promise less than a penny types of transactions for cross-border money movement. So I'm excited to see the maturation of the space, not just from crypto natives, but to traditional companies now as well.
Yeah. All right. That's a great background. Now we're going to do our best to be agnostic to all chains in this conversation, but if you tend to lean into Monad, that's great for, for those on the call. It's an ecosystem that, Neoclassic is familiar with and close to. So I guess just to set the stage, what about just a general overview of the stablecoin landscape today, and what your specific role, what you're considering as the most important segments of the market today, and then what you think is the next one to latch on in the near term?
Yeah, so I'd probably bucket it in a few different categories. You have the existing stablecoin issuers like Circle, Tether, Axos, that have been there in the market for a very long time. I think they've helped prove out a lot of the infrastructure, licensing, regulatory components, de-risked the market quite a bit. You have companies like Stripe, with the acquisition of Bridge now, that's also realized that, this is new payments technology that they should also be harnessing. You have a pretty vibrant long tail startup ecosystem across the board. Some of the battlegrounds, as I call it, where there's a lot more acute pain point that stablecoins are solving, or places like Southeast Asia, LATAM, parts of Africa, especially as well. But cross-border money movement across the board. So like it started off as a few startups experimenting, then it led to companies like World Remit that I mentioned earlier that is now saying, oh, wait, we're a large payments company. We should be able to do this also. We do cross-border money movement every single day as well. And so you're starting to see this slow maturation of, existing incumbents that have proved out the market to early stage companies experimenting with it, some growing, some continue to expand. And now you're starting to see the incumbents take notice and say, wait, we actually want to participate also, and we need infrastructure, products, and services, and we can make them available to our large distribution as well. So I think that's roughly where we are. I would say, like, to be more specific, with the backdrop of what I mentioned, we've now entered a new chapter where the Genius Act has been recently, anointed by the U.S. government. It's given a lot of regulatory clarity, and so we're at a phase now where every, traditional fintech, a financial institution, they're all racing to figure out their stablecoin strategy. So it's an action-packed period that is a lot of fun right now.
So I guess, you've seen some of these old legacy enterprises dive in. Is it really just a function of cost and efficiency? So like what was World Remit doing when you came to them and said, we have something better, and it clicked? Was it specifically just speed and efficiency, and efficiency of capital and time?
Yeah, there's a lot of it. So I think one is so efficiency and speed. I think is definitely one of them. So if you want to move money from Africa to Asia to the US all in a span of a day with Swift or existing systems, or using some type of factoring where you have liquidity in different bank accounts across different markets. Very expensive, very time consuming. Stablecoins, you can whip it around the world in seconds. You're basically moving money at internet speed, which is something we've never seen before. Um, and so I think that's for the first eye opener. Second, what was always happening is that a user that was sending money from like US to Mexico had to always settle that transaction in Mexican pesos after. Stablecoins actually give you the ability to export dollars outside the United States, but also hold them too. And many folks, that are not high net worth individuals or have private banking types of relationships, they can't go to their local bank branch and say, give me a US dollar account. It's actually just not possible. But they can go to their local crypto exchange or their local startup and say, I want to buy dollars via stablecoins. They can do that very easily. And so we're starting to see, so a lot of these remittance companies are saying, wait, we're actually seeing organic demand from our users asking for dollars and being wanting to hold dollars also outside the United States, which is really powerful. I think the other parts is 24/7. I see this with Visa specifically also. Part of the reason that Visa wanted stablecoin settlement is that it only settled 5 days a week. And every Monday morning, I remember the treasury team being very frustrated or nervous that all the wires and all the reconciliation that happened for weekend transactions, for waiting that to complete and then also accurately being dispersed, is a stressful process. And because of that, it actually increased collateral requirements that you have to have with Visa from like a risk management standpoint. Because what if a bank blew up over the weekend, and then
It
you had to
tends to over
manage
the
that risk
weekend.
on Monday?
That tends
And
to happen.
so,
Yeah.
which tends to happen, as we know.
Yeah.
And so 24/7 money movement is really powerful because you can now mitigate, long, 2 days of risk down to like the millisecond or seconds sometimes as well. You can do real-time settlement. And so I would say there's a lot of immediate benefits that I've mentioned, but there's a lot of new improvements that we haven't even started to actually fully realize yet. But stablecoins really allow companies to get into this new world of high frequency finance, which we've only seen really in the trading side, but is now evolving into the payment side as well.
Okay, and then you mentioned exporting U.S. I think all anything tokenized equities, tokenized dollars, whatever it might be, is basically exporting the U.S. economy to the world, which a lot of the world wants to have ownership and participation in. That leads to a very, a question of, do other regions and jurisdictions want that? Do they want their, domestic capital base, basically pouring their capital into US dollars? And obviously there's, certain companies that have gone the more regulated route, and there are certain companies that have gone the more unregulated route, and adoption has obviously exploded on both sides now. But how did that work both at Visa, Portal, Monad, when you're having these conversations and you want to work with, whether it be, for example, Nigeria is obviously very sensitive to their domestic currency, and Southeast Asia and most regions in the world. Like, how do those conversations work for particularly early stage companies where you don't really have the capital to be compliant in many ways or to be able to register in different jurisdictions to larger companies like Visa?
Yeah, I mean, I'd say first off, it's a mixed conversation. I think some central bankers and some regulators, they actually see it as like the inflows of capital as GDP growth because they don't actually have other maybe like a big source of GDP growth is remittances or receiving some type of capital overseas. And so it's very much a mixed bag. And I always before having these conversations, it was an eye opener for me to hear that where usually you hear the sensitive countries on the headlines like the Central Bank of Nigeria, but that's not the consistent reception across the board, which is kind of interesting. And also from a compliance standpoint, a lot of these countries that are, see GDP growth from these inflows of capital look to the US as leadership. And if they say, hey, the US has signed on with the Genius Act, that's, they can get a lot of comfort because they're like, well, that's more existential to the US, less for us. And so
Yeah.
they get to benefit from that residual opportunity. And I think at the same time, what that does is that you're seeing a lot of companies in the early stage startup, vicinity that's like, hey, this is like our opportunity now. Now there's, now like Turkey's opened up. Now like, these like large, like the Brazilian market just like announced new, regulation recently as well. And these are really big economies. So I think it does benefit the early stage startup community where there's now a better sandbox to play in versus what we had before where you're not dinged on it. So I think the compliance part's always going to be there, especially as you grow, but there's now a much better framework and thinking across regulators across some of these key markets. I would say Europe is still the hardest, in my opinion. The UK and the EU still have fairly stringent policies, but we're still seeing companies are able to get expedited licenses, or they're getting approvals in those markets as well. But we've seen a lot of change, and I think the GDP growth of the U.S. economy flowing to other markets is actually a pretty big one as well.
Yeah. And actually, I should have done this from the start, but taking a big step back, we'll go back to basics. What are the types of stable coins? There's obviously, again, we have a Tether, we have a Circle, we have a Paxos, we have a Athena. Would you mind just kind of walking
Yeah,
through high
sure. Yeah.
level?
Yeah. I mean, I think the 101 is stable coins are typically dollars on a blockchain. You're taking an ask, you have a US Treasury sitting in a bank account. You're then creating a tokenized version of it that's sitting on chain. And by digitizing the asset, you're giving it properties like 24/7 money movement at the speed of the internet, which is really, really powerful, something we've never seen before. And so I think that's really exciting. Now, the types of reserves behind the assets determines the type of asset it actually is. And so you have one class of stablecoin where USDC and Tether, the economics and the interest with the underlying reserves are given to the issuer directly. You have yield-bearing stablecoins, which are interest-bearing. So the economics are now shared freely with the holder of the actual asset itself. And then you have what I call are typically branded as stablecoins, but or more akin to a structured product is where you have some type of carry trade or some type of, trading strategy that then has some equilibrium or some type of stability tied to it based on how the strategy is defined, which is what you see with USDE and Athena. And so those are the different classes. We've historically have thought about stable coins in the form of US dollars, which make up 99% of the circulating supply, but there's a huge uptick in Mexican peso stable coins, BRL, Indian rupee, and I talked to you, you name your country, and I've probably have talked to their stablecoin issuer at this point as well. So you're starting to see the same mechanism that's been experimented with dollars for the last, 7 to 8 years is now coming to other currencies. And to be honest, stablecoins are just the beginning of this tokenization wave. I think it's the easiest one for folks to grapple with and realize, and payments and trade settlement made a lot of sense. But you're now starting to see the frameworks being used here being carried to like U.S. equities, commodities, futures, and we're only seeing this tokenization wave just beginning.
Got it. And the usage is obviously, I mean, I don't know, 2017, it was effectively USDT. When I first came into the industry full time, and it was really meant to be a trading vehicle. It was a sort of a pair trade for everything that traded on exchanges. Now you obviously have remittance, you have, consumer behavior, right? I mean, the topic of the day beyond stable and payments are prediction markets. Those are mostly done through stable coins. And so the consumer feels as though they're interacting with their dollars when in reality they're interacting with stable coins. I guess the title of this segment was Stablecoins and the $1 trillion economy of programmable money, which I came up with and I thought was a little bit over the top, but it already is in the trillions of dollars. I think if you look at settlements happening in the repo market, for example. But when you think about the scale of the potential economy and what it touches, is there any part of the market that you think is sort of like the tipping point where that's the release for, basically makes it sort of pervasive across all things?
Yeah, I mean, I think so. I think we've seen the first one. The first one is, how does stablecoins move from a crypto native, consumer base or user developer base or company base to now a traditional fintech or a bank now leveraging this technology? We're kind of in that shift that's happening right now. And what's cool is that the first chapter, which was, to your point, the first 7 to 8 years, took us to about 200 billion plus in circulating supply, which is, pretty meaningful for like an early nascent asset class. Now we're moving to the 200 billion to now, multi-trillion dollar asset class. And that's where the fintechs think like Nubank, think like Robinhoods of the world leaning in a little harder, Stripe, putting their full force behind it also. You're start seeing these companies that have massive distribution, massive user bases, large volumes that are now bringing inflows into stablecoins. I think the last part that's going to be missing afterwards is credit. As you guys know that, with the economy today, we run in a credit-based economy. There's a huge multiplier on money. As you have, bank deposits, lending practices. I think as the credit practices start to get more sophisticated longer term, it'll start to create a multiplier on the money supply that we have, accumulating with stable coins and start to dovetail into other asset classes in the future too.
Yeah, so on that point, because I personally, and my belief is that on-chain credit is probably the one of the biggest, if not the biggest, markets for the industry. When you refer to on-chain credit, there's obviously different segments to that. There's the investing world of private and public credit. There's the consumer credit side of things, which all kind of play into one another. But specifically within that world, what do you think is the next shoe to drop? And then specifically within that, what do you think is restricting the market from getting there right now?
Yeah, I think a lot of, historically when it comes to, lending practices with crypto, it's been, collateralized lending for the most part, which has its limitations. I think we haven't really, I think in the traditional finance world, you have, in the US, you have your FICO score, your credit score. You have your social security number, like your behavior as a user for the last, many years. And from that, you determine some type of credit limit, which is done through a formula. In other markets, you have, they have their own version of a credit score. Other markets, there's no credit score. And so there isn't a consensus type of formula that exists that's immutable on chain that we all can, rally around to say this is what we agree to. And if that happens, that, there's risk mitigants that take place around it. I think there's still a lot of room for, I think having strong underwriting practices that are even off chain as well before you actually bring it on chain. Not everything has to be on chain in some capacity. And so I think based on the use case, you can have that determined. And I think of the example of when you're applying for a credit card today, you throw in a few different data points, you get 25 to 35% as like your APY, and that's it. We don't have like a function like that it works on chain quite yet. But I think we'll get there eventually that people will get comfortable with. And that will be, I think, a real multiplier of money that we start to grow this economy even further.
Is that Fair Isaac, working with, some a Monad Foundation, for example, or is that maybe more Vantage, given that's sort of the flavor of the day in government? But is that because the trouble, I guess the one thing I've always struggled with on the on-chain side of the asset world is if it's not originated on chain, you still have to manage two different sort of custody processes. And then you have to really be concerned around oracles and the stability and reliability of oracles. So what do you think in your mind, putting on your Visa cap, your Portal cap, your Monad cap, what do you think that state looks like? Is it someone sort of porting all of that in through some incentive model and it's a new company, or do you think it is FICO or others engaging?
Yeah, it's a great question. I think the existing, credit, credit score companies today aren't quite there yet where they understand how to, really extrapolate their formula and like globalize it in some capacity because I think the beauty of the on-chain economy is that it's global. It's global order books, it's global money movement from day one. So I don't think they're quite there yet today. I think there is an opportunity to take a, FICO score type of formula equivalent and make that immutable on chain. It's a smart contract, so it could actually, process if there is like if you owe money and you haven't paid it back on time, the smart contract can then initiate and say, well, this position has to be liquidated, or there's like some penalty associated with it.
Yeah.
I don't think we've come to that point where there's enforcements and leveraging the immutability of code quite yet. I think oracles are definitely a big problem. If there's any delays in, how the oracle is like retrieving or processing that specific transaction or that loan, then you'll come into some challenges. And so there's still like a lot of opportunity there to innovate, and we're just scratching the surface right now.
Yeah, because I mean, auto deleveraging is not going to work in the consumer credit market. They're not
Totally.
just going to wipe somebody's collateral out for, or in that case, non-collateralized. But yeah, it's I guess that's the sort of the interesting part is we've got stable coins where they need to be. We have regulation where it needs to be. Would you say it's infrastructure or applications that are still sort of the last things to be perfected or optimized to get more usage?
Yeah, I would say like a lot of it. So, I mean, a lot of the improvements you'll get in, I would say liquidity is probably one still, like we're still growing that. I think as you're starting to have larger companies kind of move into stable coins into this world, they're now benefiting from economies of scales, which improves spreads, improves the unit economics of these transactions also, which I think is great. Because you still have to make a conversion from fiat to stable coins in some capacity. Um, I think education around the receive side said if someone wants to send stable coins over to you, if you're an importer or an exporter overseas, are you still comfortable with someone sending you stable coins immediately versus waiting for that Swift transaction? I think there's still like more room to run there from like an education standpoint. I would say from like an L1 architecture and like infrastructure standpoint, we're there. I think at this point, like we've made a ton of strides and improvements to make things sub-second finality, low transaction fees, and to plug Monad, I think that's obviously one of them. And then we also have a lot more regulatory and compliance clarity at this point too, and the best it's going to get for a long time. I think there's still a few more pieces that are be fine-tuned with like potentially the market structure bill that's coming up, but the Clarity Act, but the Genius Act has done a ton for us is in the form of an accelerant, which has actually turned stablecoins into a positive, tailwind for a lot of companies to evaluate their strategy as well.
Yeah, it seems like, I mean, again, I think we always press forward because we're seeing such massive growth in the industry and in those figures, but in the outside world, it's still relatively new. Like I recently connected one of the public payments companies to one of the biggest developers in South Florida, and they inked a deal for them to receive crypto for payment for their developments. And it was a first of its kind deal and this big splash. And I'm like, this shouldn't be a big deal, right? This should
Yeah.
just be commonplace. And I guess, listen, at the end of the day, they found a mechanism to receive the crypto, and they're obviously going to be, auto selling it into fiat or some version of digital paper in the traditional banking system. So it's not quite perfect in what we want in terms of it remaining on chain, but that shouldn't be a big deal. So it's kind of funny how, things have come so far, but we're still super, super early if you actually talk to people outside of our world, which I guess, you've been doing that for the last 10 years. I guess within that realm, which businesses, which financial services lines, which traditional enterprise lines, obviously you mentioned remittance companies. Where are you more recently having the most engaged, kind of deep down the rabbit hole, close to execution conversations?
Yeah, I would say there's a few. I think the B2B settlement side is getting really interesting also. You may be you might be an import exporter, which is something that I've been seeing quite a bit. They're obviously moving large sums of money between specific corridors. I think that's a use case that I'm seeing start to grow pretty quickly. And the interesting thing is that a lot of these import exporters are actually very comfortable with stablecoins, but they
Mhm.
actually don't really care about the underlying technology as much. They're just like, hey, as long as this can settle my transaction right away. And I'll give you an example. There was a importer from Brazil that I was talking to who's importing pistachios from Europe. He basically was saying that, my shipment in Europe doesn't get released until the Swift payment hits my exporter's bank account. And sometimes, there's Swift delays and it's 2 or 3 days, maybe sometimes it's a week.
The man needs
And
his
he's like,
pistachios.
and the guy needs his pistachios to run his business. And the beauty of it is that he's now come to an agreement with that same exporter that I'll give you 50% of this in stablecoins if you can release the shipment, and I'll send it to you today in seconds. And it's come to a point where that's how it starts. It starts with like an incremental, like, okay, fine, I'll try this out with you with a small shipment. And now you're starting to see like now that shipment was getting released, it actually accelerated their supply chain movement from waiting until this payment hits to now like this exporter feels a lot more comfortable moving that shipment over to Brazil. And so I think that's like the compounding effect that we haven't seen fully extrapolated or fully appreciated yet. But as you scale it out to like, 10 different import exporters or other 10 different B2B types of settlement agreements, it starts to get really exciting.
Yeah, that's interesting. And so we're about 8 minutes out. I do want the audience to feel free to raise the hand or drop a question into the Zoom chat, and I can bring those up in mid-conversation. I'll keep going until I see any of those. We actually have some via email that were sent over to us. So I guess to bring it way back from enterprise to the individual, we have folks on the phone, and when you think about all of these, I'm sorry, on the phone, on the Zoom call, who think about how do I get dollars on chain? So there's a lot of consumer banking apps. There's a lot of neobanks that are now adopting stable coins, and you're looking at, if you're not part of one of those platforms, for example, and you say, you know what, I've got a bunch of money sitting in my bank earning me 3% or 4% or 5%, and the on-chain economy is offering me 7 or 8, or maybe a touch less, maybe 6. But in the process of getting my capital from my bank to on chain, it's costing me 1.5%, almost 2%. And now I'm sitting in this on chain world, and I need to wait, another year to compensate me for the incremental yield I thought I was getting. So my view is always cost of capital arbitrage incentivizes behavior. So if you have cheaper cost of capital on chain, you will go after it. If you have a better sort of yield on your capital on chain, you will go after it, and vice versa. But sometimes that is mitigated or negated by the friction of bringing capital on chain. So if you were talking to a friend and he said to you, I've got money that I want to bring on chain, what are some of the simplest ways to do it? How do you guys think about that?
Yeah, I mean, there's probably a few, I mean, especially if you're in the US, there's a few different options. I think Coinbase is probably one of the better ones. Coinbase will give you, free deposits going into Coinbase. You earn, close to 4% on your money. I think that's a good one. As you start to like scale up your deposit at Coinbase, there's more products and services that you can scale into, like staking or, other types of, yield opportunities. When you're outside the United States, you have companies like Nubank that are also starting to provide like almost close to the risk-free rate outside the United States also. And so that's been a big, for like the LATAM community. So you're starting to have like household names that are providing stable coins and like I think risk-free rates around it, which is really cool. And then I think the other things is that I would always, encourage folks is to like slowly experiment with staking. I think afterwards, and staking is, is a mechanism in crypto where you can take your assets, you're now securing a network by staking it, and you're basically getting a reward for conducting that activity. And this is like a really important function for any type of blockchain ecosystem because you are securing the network at the same time as well. So the risk associated isn't actually as high as you think, but it allows you to then get, increase a little bit more yield as well. So I think that's a stepping stone that I would typically encourage is start with your local crypto exchange. From there, earn like the risk-free rate on stablecoins afterwards, and then maybe try like one of their staking products afterwards.
Mhm. Interesting. Okay. And then I guess we'll go back to sort of the TradFi world. If we think about obviously traditional import-export business, remittance businesses, Visa, which of these industries do you think personally are most at risk if they don't act quickly? For example, do you think Visa is going to work with a stack of crypto native businesses that they kind of integrate, or is it more they're going to continue to develop their own internal tech stack and that will be their crypto efforts, and then beyond that, other types of business models?
Yeah, I would say I would say the companies that are feeling the heat the most right now are cross-border payment companies. And it's funny, there's some of these like a World Remit that have been here, like I said, for 15 plus years now. They're feeling like the grunt of it because their whole business model and premise was that we do cross-border money movement really well. But it's like now like anyone can do it really well with stablecoins and blockchain. So it's like what is that incremental benefit? And some of these remittance companies charge, 5 to 10% on a transaction, which
Right.
is absurd. And I think that raises eyebrows if you're like been in the fintech space for a while, like, wow, someone can get away with 5 to 10% on a transaction. And so a lot of these companies are now, I think, are the ones that are the most, I think, pressured into the stablecoin economy, not because like they care about the technology, it's because it's actually affecting their unit economics and their whole value prop in the first place too. So I think it starts there. I think for companies like Visa that have garnered a large merchant network, Visa's got 300 million merchants. That network effect is really, really hard to prevent. But Visa's move is why not settle with stablecoins, which is like what I built like a long time ago, is as a way to say, let's just embrace new payment technology trends. Let's not fight against the current. If folks want to settle with Visa in stablecoins, whether it's crypto native and I'll give you, there's probably a few specific banks that I can't name here on this call, but there are also banks that work with Visa today that are outside of like the core 25 or so currencies that Visa typically settle with that are now using stable coins because it's actually a lot easier for them to go from like their, I can't name the specific region, I'll just give it away, but your random currency out to euros to then, back into Visa where you can go straight into stable coins afterwards. That actually is sometimes a cleaner route for some of these organizations also where maybe sourcing liquidity in dollars or other currencies are actually kind of tricky too. So it's actually still early days right now, but I see Visa as an organization embracing it fully, which is really exciting.
Yeah, it's your lasting legacy, I would say.
Well,
Um,
hopefully we have a lot more to run here, and we're still
yes.
scaling this overall economy.
The good part is in stablecoins, you don't have to worry about a 4-year cycle because it's hopefully staying at a dollar, so we
That's
can
right.
work through that. I guess another question, when companies approach you or you approach companies, I don't know what is inbound versus outbound. What do you think are the most like the major misconceptions that are blockers from people taking a next step that you can very quickly clear up and it's sort of a aha moment?
Yeah, I think sometimes people don't quite understand the risk around stablecoins. I think they assume especially if they bucket it as another crypto asset, they're like, what's the catch here? Like, why is it just still a dollar?" And I'm like, no, it's actually just U.S. Treasuries, and it's really boring. And there's attestations and audits that are done like periodically. So I think that's like the first hurdle that some folks eventually like realize like, okay, yeah, it's actually a very liquid source and the yields are actually risk-free rates. It's actually like very, very approachable. I think the other one is then understanding the blockchain. Like what is this what is a blockchain sometimes? And I think the other hard question is like which chain should I use? I think there's like it's a really
This is a
when you
clear
look
answer, right?
It's a clear answer for me now, but
Yeah,
I think before it was like, do you use Solana? Do you use Polygon? It just really isn't obvious, and I think we've created
yeah,
some complexity in the crypto space when these folks were really looking for just one. They're like, hey, what's the fastest, cheapest, most secure, and I want to go with that one. Like that's ultimately like their mental model and their framework.
yeah. I mean listen, I think even individuals that are putting, friends or family that are putting a couple dollars on chain, there's always a moment of concern as you do that when the transfer is going through before the capital actually hits the account. And maybe they don't, but you should know that there's finality there. You cannot reverse the transaction. It sits within that
Right.
wallet, within that bridge, wherever it might be. So can understand enterprises being a little bit more cautious or concerned around that. So I assume you guys work with your partners, whoever's working with Monad. Do you work very closely with them on kind of getting them sort of from 0 to 1?
Yeah, totally. I mean, between my company Portal and Monad, we're kind of we're actually like what our goal is like we want to get that developer to that aha moment where they've made that transaction exactly what you mentioned. They're like, oh, this is like exactly like making a transaction with our bank partners. It just
Yeah.
happens to be a new rail and a new payment system. And I think and then getting them to shift that stablecoins is actually a new fintech technology. Like that's really what it is. And it's funny, I'm actually hearing this a lot more from fintechs who are not attributing stablecoins to crypto anymore. They're like, yeah, this is just an evolution of fintech technology also. And so I think that's the exciting reframe that we're seeing where it's bifurcating crypto and stablecoins like altogether as well.
Yeah, I love to hear that. That's good news. All right, great. So I think we're up on time. I'm gonna put this offer out there, even though Raj did not confirm it. But anyone who has questions on the enterprise side of stablecoins, payments, remittance, a term called embedded finance that we won't bore anyone with, but you can look up on ChatGPT or Gemini later on tonight. We're happy to put you in touch with Raj. It sounds like you're working with a ton of great companies, interesting enterprises from around the world in every different industry. So I'm going to offer that. Sorry, Raj. And I appreciate your time very
Thanks.
much. Again, you've basically been 10 years in the trenches on this specific area and payments and on-chain capital movement. So it was an honor and a privilege to have you here with us tonight, or morning, for folks that are based in Asia. And just thank you. We appreciate your time.
Thanks for having me. This was awesome.